Thanks so much for tuning in to this conversation on the sidelines of the India Investor Summit at JPMorgan. With me, Sajjid, Chinoy. I need not say more. Sajjid, great having you. Thanks for taking the time.
Pleasure to be here, Neeraj.
The pleasure is entirely ours. So, Sajjid, I'm guessing investor after investor would be wanting to ask you this one question: what is happening?
And we have to start globally, right?
Yes.
Because by this time, people were saying hard landing, soft landing. Guess what? There's no visibility of any runway at the moment. The opposite is happening. We're accelerating. We're not landing at the moment, right? US growth in the first half of this year was 2%. In the third quarter, is tracking 3.5%. And so what's going on here, despite the fact that the Fed has raised rates by 500 basis points? I think the point is everybody's focused on the monetary tightening and not focused enough on the other moving parts. There are at least two moving parts. One of it is that fiscal policy in the US, rather than helping the Fed in tightening, has expanded this year. Correctly measured, the fiscal deficit is widened by 3% of GDP. Now, if this happened in an emerging market, they'd be called irresponsible and lack of coherence between fiscal and monetary, but it's happening in the US. The second fact, which is much less appreciated, is just the strength of the consumer, right? Consumption has been rock solid in the US. Part of it is that the labor market's very strong. Everybody was focusing on excess savings, and excess savings are being drawn down so this consumption spurt will end. Guess what? We're not looking at stocks, we're focusing on flows. If you focus on the stock and the wealth effect, household wealth in the US is up by $38 trillion in the last 4 years, a staggering amount. A lot of this is real estate, a lot of this is equities. So the US consumer at this point has got a huge wealth effect, right? Strong labor market, wage growth is strong, income prospects are rising, and therefore keeps marching on, right? And I think that's the part that we need to realize, that with an economy this strong, the Fed is going to be worried that even if core inflation has come down, can we really take this for granted, given the tightness in the labor market and the strength of the US consumer? And that's why the Fed has doubled down, in my mind correctly, that this is a regime that's high for long. Right? Markets, I've always believed, were a little bit irrational. Everybody wanted a soft landing, but didn't realize that with the soft landing will come an interest rate regime that will be high for long. Because the Fed did get burnt the last 2 years, its credibility was on the line, and right now you'd rather make a type 1 error, squeeze out inflation completely from the system so that inflation expectations don't get unanchored, even if it means a little less growth, than a type 2 error, cut rates too early, make the mistake that Volcker made the first time round, and risk a resurgence in inflation. So I know markets have repriced a lot the last few weeks, but if you looked at the sheer resilience of the US data the last 3 quarters, this should not be a surprise.
The debate, Sajjid, is whether, one of the debates is that whether the Fed will move from an inflation mandate, inflation targeting mandate, to an employment mandate, should employment numbers wither. My question to you is, could there be a third element out here wherein, because the US balance sheet is so indebted, if you will,
Yes,
and it can't sustain higher rates for longer, would the Fed be forced at some point of time, despite inflation being higher,
yes,
to bring down rates in order to be able to comfortably service?
And so this is fiscal dominance, right? That we call this fiscal dominance, that given that fiscal policy has moved so much, will the Fed be under pressure to keep interest rates artificially low so that debt to GDP doesn't get unhinged, right? And I think there's enough data now in the last 2-3 years to say that given that the Fed's independence is on the line, given that their inflation mandates were deeply challenged, I'd be very surprised if the Fed did that. I think the Fed right now is fighting for its reputational risk, and that would mean to bring inflation down to the 2 handle and keep it there. Yes, if there is a recession in the few months, because I think what we're not recognizing is if monetary conditions are so tight that you've actually got 10-year yields close to 4.5%, compounded by a stronger dollar, that's the second piece we should talk about, right? That at some point something may break in the coming months, or you risk increasingly a hard landing. If you keep rates very high for long, at some point in 24, maybe 25, you get a hard landing. If one of those things happen and you get bleeding in the labor market, then yes, of course, the Fed will pivot. But that is only because that kind of recession or bleeding in the labor market will help the Fed's disinflationary cause.
Mm-hmm. So what happened in a scenario, because I was reading this note from David Rosenberg, if I'm not wrong, that typically 11 of the 14 cycles wherein the interest rates have been increased this fast, there is a hard landing at some point of time and it will have its collateral impact.
Yes.
What is your base case?
And the reason why history may not be the best guide is because we're truly in an unprecedented situation, right? That it's not clear that in those cycles, fiscal policy was working the other direction, right? So yes, monetary policy by itself should engineer a slowdown, but when fiscal is expanding, you're undoing some of that slowdown, number one. And this wealth effect that I spoke about is quite unprecedented, right? So you've got monetary policy now that's facing other forces, a very strong balance sheet by households and corporates, and fiscal policy that's expanding. So this could take longer to actually have effect, which is why the Fed will be noticeable, will be visibly conservative and nervous that this disinflation may not last.
Okay, so in which case, Sajjid, what's the net effect of higher for longer rates, presumably a strengthening dollar which could actually go up further? So a view there, of course, and then the resultant impact on the other asset classes, but particularly emerging markets.
Right. So I think emerging markets now are facing a much more hostile backdrop because you've got three variables that are moving against you. One is rates are higher for longer. The second is you're getting US exceptionalism. That even as you're getting very strong growth in the US this year, Europe is stagnant. It's basically stalled. We expect European growth this year could be 0.5% or the risks are to the downside. And China has disappointed. And that's what explains the strong dollar. That you've got US exceptionalism even as the rest of the world is disappointing. So you've got now a stronger dollar, higher rates, and higher crude prices, right? And that's happening because there's a supply cut over there. So this is a little bit of a mini rerun of what happened in 22. Now, 22 was so potent because you had this very aggressive rate hiking cycle. You had a stronger dollar because of it, and you had higher crude prices. So for a commodity and capital importing country like India, you were hit both on the current account and the capital account. The current account because of higher crude prices, the capital account because of the stronger dollar. Right? Now, of course, the quantums are much larger last year, but directionally, emerging markets are facing that same perfect storm. Stronger dollar, higher oil, higher for longer rates. And I think in that environment, macroeconomic stability will need to dominate in the coming months to try and get through this period.
Okay. Now, I will come to how does India therefore behave also in relation to what's happening to the world, but also in relation to its past, right? And especially, I think your recent note speaks a lot of taper tantrum episode in 2013. You made a reference to 2022 as well, right? And therefore, there's a bit of a recency memory to that as well. What is India better placed because of some things that have been steps that have been taken both on the fiscal and the monetary side? Part one of my question. And is this a natural evolution which will hold it in good stead? Or are there some more steps that definitely need to be taken and safeguarded against?
Great question. So I think there's no doubt that there's been a massive transformation on the macro stability front over the last 10 years. And to policymakers' credit, it started right after the last taper tantrum. I think there were two immediate realizations. One is that you can't have a situation where inflation is in double digits like it was in 2011, 2012. And so we've had an institutionalized flexible inflation target. I think people don't appreciate how well it's performed. Between 2016 and 2020 January, headline CPI averaged 4%. We actually met our target. Now, between 20 and 23, it's averaged 6% for reasons we all know, but at least we're in that band. And the MPC, through its action, seems determined to bring inflation back in the band. So you're seeing a massive downshift in inflation. Along with that has come higher real rates. Real rates were deeply negative 2010, 11, 12. Real rates have been consistently positive since then. They were negative in the pandemic. We're back again in positive territory, right? I think the second lesson was buffers matter. That foreign exchange currency buffers matter hugely, and perceptions of buffers matter, right? India had sufficient buffers in 2013 by conventional standards. We had reserves were $280 billion, and it was worth almost 6 months of imports, and that's more than sufficient. But the perception was that India didn't have enough. And then that creates a catch-22, because if the central bank intervenes and uses buffers and you run it down, then you're accentuating the perception that there is inadequate buffers. If you don't use buffers and the exchange rate overshoots, then that begets more weakness. So I think what the central bank has correctly done, in my view, in the last 10 years, is that every opportunity buy dollars. Right? At the start of 22, we had almost 700 billion. And there was no shadow of a doubt that the central bank had more than enough ammunition. It could intervene expansively. It did almost $90 billion in the middle of last year and still have enough. So I think the second lesson is buffers matter. The third is that external metrics matter. We've always been a country with low external debt. But there was a perception somehow in 2009, 10, 11, 12 that the exchange rate was strengthening, was misaligned, was overvalued. The last 4 or 5 years, Neeraj, if you look at the broad trade-weighted real effective exchange rate, it's basically flat. Now, I personally, as an economist, would like a slightly weaker exchange rate to boost competitiveness in a world in which exports will be challenged. But at least there is no market perception that this exchange rate is misaligned. So I think there's been a very conscious effort to ensure that the fundamentals, exchange rates, foreign exchange reserves, real interest rates, inflation, has gapped down and is within sustainable levels. And therefore, there's been such a strong evolution. I'll end by saying, you said, is there unfinished business? There always is. In our case, it'll have to be on the fiscal. We have, to policymakers' credit, there is a fiscal consolidation roadmap, but it's important, I think, to be on that roadmap and, if possible, from next year, beat that roadmap. Because when you think of the current account is nothing but the investment saving gap of the economy, which is the consolidated fiscal deficit and the private sector's investment saving gap. Now, if you do get a private capex cycle, as we are all hoping, in the coming years, then by definition, the private sector's investment saving balance will worsen to finance that capex cycle. And that's precisely, you want the government deficits to come down so that this does not spill over into a current account deficit.
Got it. Okay, so I have 3 follow-ups to this last answer. The first one is on buffers. Now, for the last 18 months, at every sign of the Forex reserves coming off, there has been a cautionary warning from a few people that, let's watch this number very carefully. My question is, cycles are getting a bit constricted and things are developing before people quite envisage that this may happen. So therefore, is this a good enough level for people to find comfort with? I mean, you can argue that no level is good enough.
Yes.
Maybe we are double the reserves that we have, and still people will say, oh, safeguard against it.
Yes.
But I'm asking you, where do you think is a sweet spot for you to feel comfort with India's Forex reserves? Simply because what happens 12 months out is unpredictable.
We are very, very comfortable. I think nobody should be under any doubt about that. Just think of the metrics. They say, the IMF will say, the best way to measure reserves is to say, what are your total gross financing requirements over the next 12 months? What is all the debt that's coming due in the next 12 months, residual maturity of 12 months or less, and your entire projected current account deficit for the next 12 months? And do you have reserves to cover that entire amount? So the idea is, if you don't get a single dollar of capital inflows, can your reserves finance your entire current account and all the debt coming due? And if you have a ratio of 1, that's considered adequate. India's ratio is 1.8. It's almost double. Right? We have almost 11 months of imports. So by all measures, we have adequate reserves. Now, this doesn't mean that the RBI should stop buying dollars, because 2 things. When you build reserves like in Asia, where this is run by current account surpluses, these are your earned reserves. When you build reserves because there are capital inflows, like in India, because we're a current account deficit country, these are borrowed reserves, in the sense that when capital comes in, there's a liability somewhere in the economy. And the central bank, if the central bank is worried that the liability could unwind tomorrow, if global conditions change, you want to hold on to those reserves and sell them when the liability unwinds. So I think the RBI should and may and will, in my mind, continue buying reserves. Also, when we speak about the exchange rate not being competitive, you're buying reserves for 2 reasons. One is to build buffers, and the second is to prevent a real appreciation of the currency.
Yeah. Okay. A follow-up to that, and then I'll come to the previous answer as well. But a lot of chatter around FDI, and I know the flows numbers don't quite bring that out, but with an assumption that at some point of time, a lot of these conversations will bring in even more numbers on the FDI front, which is not flighty capital, but near permanent capital.
Yes.
And then the inclusion of the Indian bond markets into the JPMorgan global, and therefore that capital likely again will not be flighty, but will be something that will come in there. Do all of these give some bit of confidence around not meaningfully large flows, but decently large flows over the next 24 months?
They do. At this point, FDI flows have slowed a lot. So we have to keep a very close watch on that. What used to be $45 billion is tracking closer in the last 12 months, trailing 12-month average 25 billion. Now, maybe just because financial conditions are so tight around the world, but we have to keep a very close eye, which is why at least over the next 12, 24 months, when you get this one-time bond index flow, which was passive money and therefore stable, hopefully it'll offset the FDI. But at this point, I won't say that India's got this huge surplus of flows for now, because the index flows will offset the FDI flows. And remember, with crude at 90 or 90 in that range, it will mean that the current account deficit is wider. So we're comfortable in the BOP, but we're not in a situation yet to say that we've got this massive BOP surplus that the RBI should necessarily be worried about at this point in time.
By the way, do you find comfort with this inclusion happening at the current point of time? Because a lot of people would have thought that the reverse will hold true when an event happens, and if there is a flight out, even that might be a problem. But is Indian as an economy being so large and having the depth, is it a good time for India to be included?
It was inevitable. I think it's a good time because if you want idiosyncratic one-off flows, you want those flows to be counter-cyclical. You don't want them to be when your flows are already very strong, because that makes the RBI's problem worse. You want them at a time, for example, where FDI flows have slowed and the current account is wider because oil prices have gone up. So this is a good time. Couple of things, nuances here. One is that I think the benefit of this, as we've alluded to, is the passivity. That these are passive flows, and if people get excited about India, you take your weightage in India from 10% to 12%. You go overweight. As an example, if you're a little concerned, 10 becomes 8. So you don't see very large swings. And this brings much needed heterogeneity to the bond market. And I think that's good in the medium term for price discovery and for the health of the market. But we should be realistic precisely for the reasons we mentioned on what this means for market prices. Because when these flows come in, for all the reasons we've discussed, the RBI will probably buy those dollars up to prevent an appreciation of the currency. When you buy those dollars up, you will release rupee liquidity. And the RBI correctly wants to ensure that liquidity does not go out of hand, right? And is consistent with your monetary policy stance. So then you will sterilize that liquidity. And one potential way of sterilizing it is to sell government bonds and soak it up. So in a way, what this will do is, this is very supportive for the BOP. But from a bond market perspective, think of this as being potentially a change in the central bank's balance sheet, away from net domestic assets to net foreign assets. That you're buying more dollars, but because you have to sterilize that, you are selling bonds and reducing that exposure.
Got it. Okay. Now, Sajjid, and I'll save the taper time. One more question on taper tantrum for the last. But before that, like I said, I have a couple of follow-ups.
Sure.
So one of the things that comes up in a few conversations with people who look at the glass half full is that, could India be moving towards CAD neutrality over the course of the next 2-3 years? And what's the net result or impact of that?
And I think that comes from the fact that service exports have done so well, right? And that's a huge positive for India. The fact that we've now moved away from non-IT services. JPMorgan has 55,000 people in India, right? Most of our global research, technology, cybersecurity, legal, accounting is done from India, and many multinational companies are following suit. Now, I'm going to take the opposite stand, that it is not desirable for India to have a zero current account deficit or a current account surplus, because given our level of per capita income, as I mentioned, the current account is simply the investment savings gap. We want more investment. We want more investment than our domestic savings can finance, and therefore it's desirable to run a sustainable current account deficit, 2% of GDP. Operationally, what you will see, hopefully, is that even as savings have picked up, service exports have picked up, when we do get that private capex cycle we've all been waiting for, right, and domestic demand strengthens and broadens, that will show up in higher imports. Right now, most of our imports are consumer goods imports. What we want are capital goods imports to reflect the fact that a capex cycle has started. So it's not a good thing to run a current account surplus, because that may be an indication of depressed demand. You want to run a current account deficit at our level of income to attract stable capital from the world, FDI, for example, right? So think of the current account deficit as being foreign savings that are augmenting domestic savings to finance investment, which is what we want.
Right. But it could well happen that the nature of this whole equation may change, in that there are higher exports, services plus maybe goods, hopefully, and there are reduced imports, even though it's just a trickle right now. But we're seeing electronic imports getting attacked meaningfully. So could it happen that what will be the nature of the current account deficit 2 years out or 3 years out?
Different.
Yes.
Yeah, I'd be a little bit more careful about extrapolating on exports because unlike the 2003 to 2008 cycle, we're seeing a world that's becoming more and more protectionist, more and more deglobalized, more and more economically balkanized. So at least on the goods front, we'll have to work really hard to boost our goods exports. This is not like a rising tide lifts all boats. We'll have to work hard to increase our share. Service exports have done very well, but for the last few months, if you'll notice, they've kind of tapered off in level terms. So it's a high level, but we're at that kind of $27, $28 billion gross service exports a month for the last 5 or 6 months. So this is really good, but we shouldn't presume that exports are going to be strong till the eye can see. We have to work to make that happen.
Got it. Sajjid, a quick update about what is the reason? Is it tighter liquidity or something else that is not resulting in the numbers on the capital inflows into India of the permanent nature or the FDI nature being meaningful? Because corporate after corporate that I speak to on the global front, they're all talking about how India is in the thick of things in their scheme of things. Yes. Why is it not showing into numbers?
Sometimes these just take lags, right? So when you talk about China plus one, corporates express intentions. By the time the project is actually executed and you attract flows, it takes time. Having said that, we need to be acutely aware that there's a lot of competition for China plus one business, right? One of the biggest competitors is Mexico, for example. Vietnam has done very well. So there are countries all around the world that are vying for some of the China plus one share. And don't forget the fact that there are massive subsidies by industrial economies, by the US, by Europe, to reshore some of this business back. So now we're competing with the US, with Europe, with Mexico, with Vietnam, with Thailand, with Indonesia, which means we've made a good start in some sectors, clearly, but we can't take it for granted. We have to keep working hard and doubling down on improving India's attractiveness. The fact that we have a large market that grows at every year is clearly attractive, but we have to keep working on boosting competitiveness, given how acute the competition is.
Got it. You spoke about US exceptionalism when it comes to growth, maybe inflation, maybe everything else, right? My question is, could India be not in that bad a boat simply because if the world over, except US, everything else is slowing down, then that imported inflation in some sense comes down. And currently also we are in a bit of in that band, even though at the higher end of the band. So could the next 12 months, could it be that inflationary pressures will not be the biggest problem for India? Oil prices remaining constant.
Yes. So exactly said that. Barring any more adverse supply shocks, at some point you would assume that gravitational forces would kick in and the global economy would slow. And India always has a hedge. We have a couple of hedges, natural hedges, that when global growth slows and your exports get impacted, it typically means that commodity prices come off. And as a large commodity importer, you get a terms of trade benefit. So the terms of trade benefit offset some of slowing exports. There's another hedge, which is that typically a stronger dollar is accompanied by lower crude prices. Typically, it's not happening right now. And so that's the hedge on the balance of payments, in that when you have high crude prices, that pressures your current account, but if it's accompanied by a weaker dollar, given the inverse correlation, it helps your capital account. Now, if those correlations hold, we should be fine. The two supply shocks that I'd carefully focus on from an inflation perspective is the crude shock that we spoke about globally, but the monsoon at home. It's been a very uneven monsoon, both temporally and spatially. And so we have to keep a very close eye on things like, rice prices and pulse prices. The world has had enough adverse supply shocks the last 4 years, right? Manufacturing supply chains, crude, food, labor markets. We need to hope and pray that you don't get another couple of supply shocks in terms of crude for the next year and the monsoon in India. But those are the two things I focus on.
Does the monsoon worry you?
Much less so today than 3 weeks ago. We wrote a piece saying that August was the driest August in history of India. But the last 20 years, what we've seen, last 40 years, what we've seen is when you have a dry August compounded by a dry September, the food inflation outlook is much worse. The good news is September is running 15% above normal. So it's offset for what's happened in August. And again, here, I think we have to give policymakers credit. The last 2 times in the decade, we had a deficient monsoon. Food inflation over the next 12 months actually came down because of front-loaded preemptive policy actions, right? Importing pulses, cutting duties, releasing buffer stocks. So I think the government again has started that process. Hopefully our policy response can be nimble and preemptive and dampen any food price pressures.
Cross fingers, especially in the next 12 months, which is an election calendar, very important. Last question, and we kind of briefly spoke about it, but you wrote this wonderful note on 10 years from the taper tantrum, lessons from there, as well as how India is different. Now, we briefly spoke about it, but I would love to end this conversation with a slightly elaborate answer there, Sajjid. India currently, relative to 2013, relative to maybe even 2022, if you will, and how better placed would we be over the course of the next few years, other things remaining constant?
Yes. No, so I think policymakers over the last 10 years deserve enormous credit for institutionalizing a lot of the macroeconomic stability, whether it's through reserves, through inflation targeting, through real rates. I think the lesson from the last 10 years is there is no trade-off between macroeconomic stability and growth. That growth is that which occurs on the foundation of long years of hard work in building macro stability. And it's important to remind ourselves this because, you see, unlike growth enhancing reforms, you do a reform and there's an immediate payoff. In the case of macro stability, your success is defined by not what you achieve, but what you avoid, which is the crisis. So the fact that nobody even realized that in 2022, the pressures that India faced were as acute as 2013 is a sign of success to all that was done over the last 10 years. So I think we need to keep reminding ourselves of that and persevere with all of that, and with the exception that the fiscal needs to come down. I think on the growth front, I'll just end, lots of good things are coming together. We're seeing the healthiest balance sheets in the last decade, financial sector balance sheets, corporate deleveraging has happened, infrastructure is being built, the real estate cycle is picking up, service exports have done well. That said, we need to keep working on that. Just I'll end with one number here, that a lot of our growth in the last 3 years has actually happened on the export because of exports. Exports have been disproportionately very strong. Now, for all the reasons we discussed over the next 2-3 years, we shouldn't expect those kind of export tailwinds. So a lot of the growth will need to happen through domestic demand. Public investment has been doing all the heavy lifting so far. So we need to ensure that we get ever closer to and finally see a private investment cycle kicking in and work towards that. And on consumption, again, tantalizing signs, but a lot of the consumption has been driven by the upper end. We need for consumption to broaden out. So lots of good things are happening on the growth front, but we need to ensure that domestic demand broadens and deepens. You need both public capex and private capex. You need both upper end consumption and lower end consumption to drive domestic demand in a world in which the export tailwinds, unlike 2003 to 2010, become less reliable.
Got it. I know you're running short of time, but I'm tempted to just ask you one more question. Apologies for that. Should a lot of these things not happen, which is that consumption, particularly the lower end, doesn't quite pick up? We know the upper end consumption is doing okay, the lower end doesn't pick up. If private capex doesn't meaningfully come around, and the opinion is divided out there about even the present, so I don't know what happens out there, but let's assume it doesn't quite come around for whatever reason. And in your note and in this conversation, you've spoken about the importance of the government sticking and beating the fiscal glide path. What would you rather have the government do in a scenario wherein consumption doesn't pick up and private capex doesn't come in? Should the government still go ahead and not stimulate via fiscal?
It's a very good question. So I think just before I answer that, I think the key to lower end consumption is just blue collar job creation. We've seen that we're very good at white collar job creation, right? All these global service centers, exports, service exports, unicorns, banks, technology companies. We need to double down on blue collar job creation because that's the surest way to ensure a bottom end consumption, mass market consumption. Now, you raise a very good question. We have a large fiscal deficit. The public sector borrowing requirement is above 9% of GDP. What happens if the domestic private sector disappoints? There is a way to do both things, Neeraj, and I'll tell you how. Post the election, you don't want to take your foot off the gas on physical infrastructure. The government's done a wonderful job in boosting public capex. We need more of that. In fact, we need more spending on health and education. Now, how do you finance high levels of spending on needed physical and social infrastructure and bring the deficit down? Revenue generation. And there are two kinds I'm going to touch on. One is asset sales. that we've identified a lot of assets that we can potentially sell. I think the next administration should double down on asset sales. That allows you to keep expenditure levels high and still bring your deficits down. I think lots of good things are happening on GST, right? I think more can happen to ensure that rates get rationalized, the base is broadened further, and we need some direct tax reform. So I would say revenue reforms, including asset monetization, will have to become a key part of what happens in 24 onwards, precisely for the reasons you mentioned. That we have to bring fiscal deficits down for macro stability, but we can't suddenly let go of public capex because private sector could still take some time to join the party.
Sajjid, thank you so much for all of these points. It's always a pleasure talking to you, more so during such a busy time. Thanks for taking the time.
Real pleasure, Neeraj. Always a pleasure. Thank you.
Thank you so much, and viewers, thanks for tuning in.